Have you ever, hit pay on your monthly insurance premium, watched that money leave your checking account, and just wondered where is this actually going? Like, how much of that chunk of change is being set aside to pay for real-world accidents, and how much is just vanishing straight into a corporate vault somewhere to, I don't know, fund the CEO's bonus?
Yeah, I mean, that is the ultimate consumer question. We all pay these premiums mostly because we legally have to or the bank makes us. But the actual mechanics of where those dollars go once they leave our hands, well, it can feel like looking into a complete black box.
Right, exactly. And today we are opening up that black box. We are jumping into a deep dive on a stack of research from the Insurance Study Companion, specifically focusing on a module titled 019 loss ratio. It is the single most vital metric in the entire insurance industry.
Oh, without a doubt.
And whether you are an insurance student frantically cramming for a CPCU exam right now, an industry professional looking to brush up, or just an insanely curious consumer who wants to know how the sausage is made with your own money, this deep dive is going to decode exactly how insurers grade their own survival. So, okay, let's unpack this.
Well, to really understand the loss ratio, we kind of have to strip away the massive corporate spreadsheets and multi-million-dollar disaster payouts for a second. Think of it as a slice of a pie.
Okay, a pie.
Yeah. If an insurer collects $1 from you, they need a metric to tell them exactly how many cents out of that dollar are actually being spent to, fix broken windshields, rebuild burnt-down kitchens, or settle lawsuits.
Right.
The formal definition is that it's the percentage of earned premium that an insurer pays or expects to pay for covered losses.
So, to put this in normal human terms, let's talk about my paycheck. Say I bring home $1,000 a week. And out of that $1,000, I spend $600 on groceries, eating out, and just feeding myself. If we were making up a financial metric for my personal life, you could say I have a 60% grocery ratio.
I love that. Yes, that analogy translates perfectly to the corporate side. The insurance company takes in a pile of money, which they call earned premium. Out of that pile, they spend a specific amount on covered claims, which they call incurred losses.
Right.
So if you take those losses, divide them by the premium, and multiply by 100, you get your percentage. That's the formula. Loss ratio equals incurred losses divided by earned premium times 100%.
So if an insurance company collects $100 million in premium across all their policyholders, and they pay out $60 million in claims, they divide 60 by 100, and they have a 60% loss ratio.
Exactly.
Meaning for every dollar that comes in, 60 cents goes right back out the door to fix their customers' problems.
You have the math down perfectly.
Yeah.
But what's fascinating here is, and this is the crucial detail to remember, this metric looks at claims and claims only. It explicitly ignores every other cost of running a business.
Which means that remaining 40 cents out of the dollar isn't just pure unadulterated profit?
Oh, far from it.
Right.
That remaining 40% has to stretch incredibly far. It has to cover the employee salaries, the electric bill at the headquarters, the massive software systems they use, the marketing budget.
Right, like those billions spent on TV commercials with the lizards and the emus.
Exactly, all of that, plus agent commissions and taxes. Only after all of those operational expenses are paid out of that 40 cents is there any hope of the company actually turning an underwriting profit.
Man, that puts a massive amount of pressure on that remaining slice of the pie. A 60% loss ratio sounds manageable when we use clean, simple numbers like $100. But when a company is dealing with completely unpredictable disasters, those numbers must get incredibly messy.
They absolutely do.
Like, I'm looking at an example in the research regarding a regional homeowners insurance provider. Let's say this company reports $200 million in premium coming in for the year.
Right, a solid year of revenue. And let's say they look at their bank accounts and see they have paid out $110 million in actual claims so far.
Wait, hold on. Let me stop you there because the math in this example is doing something weird. The company physically wrote checks for $110 million. But to calculate the loss ratio, the source says the incurred losses, the pop number of our fraction is 120 million.
Yes.
Where did that phantom $10 million come from? Did they just invent $10 million of losses to make their taxes look better?
It definitely looks like a phantom number at first glance, I'll give you that. But it represents the most critical, heavily regulated part of how insurance accounting works. There is a massive difference between paid claims and incurred losses.
Break that down for me, because to the average person, a claim they paid is a loss they incurred.
Well, paid claims are exactly what they sound like, the actual checks the company has already written, signed, and mailed out. The money has left the building. But Incurred losses, which is the mandatory number for the loss ratio, equals the paid losses plus something called the change in loss reserves.
Loss reserves, meaning like money they're just holding on to in a vault.
Basically, yes. Money they're legally obligated to hold on to because they know they're going to have to pay it out eventually. Consider a real-world scenario. Let's say a massive oak tree falls on your roof during a storm in late November.
Okay, right near the end of the year.
Right. You file the claim, the adjuster comes out, and they agree the repair will cost $30,000. But the roofing contractors are booked solid, and they can't actually do the work until March.
Ah, so the insurance company hasn't written the check in November. The money is still sitting in their bank account.
But they know that bill is coming. If they close their financial books on December 31st and pretend they don't owe you $30,000 just because they haven't mailed the check yet, they're misrepresenting their financial health. They have to reserve that money.
That makes total sense.
And it gets even more complicated with liability claims. Say someone slips and falls in a grocery store and sues for $2 million. That lawsuit might take 4 years to work its way through the courts. The insurance company's actuaries have to estimate what that claim will eventually cost and lock that money away today.
Oh, wow, I see. So that phantom $10 million in our example is the increase in those loss reserves. It's a combination of the roofs that haven't been fixed yet and the lawsuits that haven't been settled yet. They haven't written the checks, but they are fully on the hook.
Which is why you add the $110 million in actual paid claims to the $10 million they just had to lock away in loss reserves. That gives you your true incurred losses of $120 million.
And then you divide that by your $200 million in premium, and boom, you arrive at a 60% loss ratio.
Exactly. It gives a much more honest picture of the company's liabilities.
Okay, so knowing the math is one thing, but how do insurance executives actually use the 60% figure on a Tuesday morning to run their business? Because if I'm the CEO of this company and my entire goal is to make my shareholders happy, I'm looking at that 60% and thinking, well, 0% is the dream, right?
I think so, yeah.
If I can collect $200 million in premium and somehow manage to pay out absolutely $0 in claims, I win the game. The goal has to be pushing this number as close to zero as humanly possible.
It is very tempting to look at it through that lens, I know. But in the insurance world, a gently pushing back here, a 0% loss ratio, or even a shockingly low one, like 20%, is actually a massive red flag. It isn't the sustainable dream you might think it is.
Wait, really? Why wouldn't a business want to keep all the money they take in?
Because it usually implies one of two things, and honestly, neither is good for long-term survival. First, it might mean your pricing is absurdly conservative. You are charging your customers so much for their premiums that you have essentially priced yourself out of the market.
Oh, I see.
You might have a great loss ratio this year, but by next year, every single one of your customers is going to realize they are being overcharged, and they will flee to competitors offering a fairer price.
Yeah, that makes total sense.
Yeah.
If my auto insurance is 3 times higher than my neighbor's and I've never been in an accident, I'm absolutely shopping around.
Exactly. And the second possibility for an artificially low loss ratio is that you just got incredibly lucky. Maybe you sell coastal property insurance, and by some miracle, there were 0 hurricanes or major storms that entire year. It's a fluke. You can't base your 5-year corporate strategy on the hope that the weather will always be perfect.
So it's a tightrope walk. You don't want it to be 0, but you obviously don't want it to be 100% either.
It is a delicate balancing act, and this single metric dictates everything. It acts as the central nervous system for 4 major departments.
Okay, let's break those down.
Let's start with underwriting. These are the people deciding who actually gets a policy and who gets rejected. A consistently high loss ratio in a specific demographic or region signals poor risk selection. It tells the executives that the underwriters are saying yes to properties or drivers that are simply too risky, and those risks are blowing up into expensive claims.
Which naturally forces a reaction from the pricing department, I assume, because if the underwriters are bringing in bad risks and the loss ratio is spiking to, say, 85 or 90%, the premiums coming in aren't big enough to cover the cash going out.
Spot on. And that triggers a feedback loop. High loss ratios force companies to file for rate hikes with state regulators. If they are paying out 90 cents on every dollar just to fix cars, they literally cannot afford to keep the lights on with the remaining 10 cents. They have to raise everyone's rates to survive.
Right. And what happens in the claims management department? because the research mentions they are constantly battling two forces: claim frequency and claim severity.
Yeah, those are the twin engines driving the loss ratio upward. Claim frequency is simply the raw volume of claims. Like, if more people are driving to work instead of working from home, there are more cars on the road, which means more accidents. More accidents mean higher frequency.
And claim severity is how brutally expensive each of those individual accidents happens to be.
Precisely. Think about what happens when you rear-end someone today versus 20 years ago. If you bumped a 1998 sedan, you dented a piece of plastic. Maybe it cost $500 to fix.
Yeah, a quick trip to the body shop.
But if you bump a 2024 electric vehicle, you are crushing backup cameras, ultrasonic sensors, and complex bumper housing. A minor fender bender is suddenly a $4,000 repair.
So people are getting into more accidents because they are distracted by their phones. That's frequency. And the cars they are hitting are basically rolling supercomputers. That's severity.
Exactly. Both of those forces push the loss ratio up, which means the company has to be ruthlessly efficient in how they handle those claims, just to keep their head above water.
Man. And that brings us to the fourth area: risk management.
Right. The executive team doesn't just look at one massive company-wide loss ratio and call it a day. They slice and dice this metric with surgical precision. Management continuously monitors it by product, by state, by specific lines of business, and by underwriting segment.
So they use it as a metal detector to hunt down the unprofitable areas.
They do. They might look at their dashboards and realize, our auto insurance product in Ohio is performing beautifully with a steady 65% loss ratio. But our commercial property insurance in Florida is running at a disastrous 110%.
Ouch.
Yeah, so they use this granular data to make massive strategic decisions. They might pour marketing dollars into Ohio to grow that business, while completely pulling out of certain zip codes in Florida.
Because getting this calculation wrong doesn't just mean a bad quarter, it means the company goes bankrupt and people lose their safety nets. Which is precisely why this concept is the holy grail for anyone taking professional insurance exams.
Oh, absolutely.
If you are sitting for a CPCU course like 520, 540, ANS, AIC, or API, you are going to be tested on this. And looking at the research, there are a few massive traps where people consistently stumble. So here's where it gets really interesting for the students listening.
The exam writers know exactly how to test if you truly understand the mechanics, rather than just memorizing a formula. The biggest stumbling block usually involves exam trap 1, the bottom number of our fraction, the denominator.
Right, the premium.
The trap is confusing written premium with earned premium. A massive red flag in the notes is using written premium instead of earned premium.
Let's explore why that distinction exists, because on the surface, I mean, premium is premium. If I go online today and buy a 12-month auto insurance policy for $1,200, the insurance company just made $1,200, right?
Well, they secured a contract for $1,200, which they log as written premium. They wrote the policy today, but they have absolutely not earned that money yet. And this is a massive consumer protection issue.
Because they haven't actually provided the service yet.
Think of it from a regulatory standpoint. The insurance company only earns that money day by day, month by month, as they actually provide the promised protection. After 1 month of driving, they have only earned $100 of your premium. The other $1,100 is unearned. It has to sit in a protected reserve.
Oh, I see where this is going. If the company goes bankrupt in month 2, or if I just decide to cancel my policy and sell my car, that remaining $1,100 isn't theirs to keep. They have to refund it to me.
Precisely. They cannot use unearned premium to pay today's claims. Therefore, when you calculate the loss ratio to judge the company's performance, you can only measure the losses against the premium they have actually earned. The golden rule for any exam and for real-world accounting is that the loss ratio always uses earned premium.
So if you see a word problem throwing written premium at you, cross it out. It is a decoy designed to ruin your math.
Exactly.
That is a brilliant distinction. So rule number 1, always use earned premium. But there's another area where people get tangled up, exam trap 2, and that's confusing the loss ratio with the combined ratio.
This takes us all the way back to the beginning of our conversation when we talked about the remaining 40 cents out of that dollar. Remember, the loss ratio measures claims and only claims. It doesn't care about the electric bill, the agent commissions, or the TV commercials.
Right, our 60% loss ratio just covered the dented bumpers and the ruined roofs. But a business still has to pay its employees.
That is where a second metric, the expense ratio, enters the picture. The expense ratio measures all of those operating expenses relative to the premiums coming in. So if we take the loss ratio, which is the money going out for claims, and we add the expense ratio, which is the money going out for operations, we get the combined ratio.
Loss ratio plus expense ratio equals combined ratio. You literally combine the two biggest outgoing piles of cash to see the total financial footprint.
And that combined ratio is the ultimate, undeniable indicator of a company's underwriting profitability. A combined ratio under 100% is the promised land.
So if a company has a 60% loss ratio and a 30% expense ratio, their combined ratio is 90%.
Which means that for every dollar they take in, they are spending 90 cents on claims and operations combined. They have a 10-cent underwriting profit left over.
But consider the alternative. What if a surge in bad weather pushes their loss ratio to 80% and their operations still costs 30%? Now, their combined ratio is 110%.
Exactly.
Okay, they're paying out $1.10 for every dollar they bring in. They're just bleeding money at that point.
They are losing money on their core business of underwriting. Now, they might still survive because they invest all those premiums in the stock market and bonds before they have to pay them out, which generates investment income. But strictly from an insurance standpoint, a combined ratio over 100 means the fundamental business model is currently operating at a loss.
Wow. Okay, we have navigated some seriously complex terrain today, from grocery budgets and phantom money vaults to the brutal realities of underwriting profitability. Let's lock in a concise recap of the core takeaways. The absolute foundation is the formula loss ratio equals incurred losses divided by earned premium.
It acts as the heartbeat monitor for the company, revealing exactly how much of each premium dollar is being consumed by customer claims. Lower ratios generally signal healthier underwriting performance, provided the premiums remain competitive and they aren't losing market share.
Right. And higher ratios mean those premium dollars are being eaten alive by claims, forcing executives to either hike rates, tighten their underwriting standards, or pull out of risky areas entirely.
And for the students listening, the unbreakable rules are: incurred losses include both paid claims and the money reserved for future claims. You always divide by earned premium, never written premium, and if you add the company's operating expenses into the mix, you upgrade from the loss ratio to the combined ratio.
So what does this all mean for you? Whether you are walking into a testing center tomorrow morning to conquer a CPCU exam, or you are just sitting at your kitchen table next week staring at a rate increase on your auto insurance renewal, you now understand the exact mathematical machinery that justifies those numbers.
It totally changes how you look at the industry, doesn't it? You realize they aren't just making up numbers, they are balancing massive, unpredictable liabilities on a razor-thin margin. But, take that a step further, though. We discussed earlier how an incredibly low loss ratio might mean a company is utilizing conservative pricing. If an insurance provider is celebrating a 50% loss ratio year after year, throwing parties for their shareholders, it means they are collecting massive amounts of premium from everyday consumers, but paying out very little when things go wrong.
They are essentially hoarding the cash.
Right. So at what point does a highly profitable loss ratio cross an invisible line? When does it stop being a sign of smart, efficient underwriting and start being a scenario where hardworking customers are simply overpaying for a safety net they aren't actually benefiting from? Where exactly is the line between good business and a genuinely bad deal for the consumer?
Man, that is a phenomenal question to chew on. Next time you hit pay on that monthly premium, you might just find yourself reverse engineering the math to figure out who's really getting the better end of the deal. Keep that in mind, and we will catch you on the next deep dive.